Well, hi, I'm John Stevens, and this is Financial Literacy. Dun, dun, dun. Today we're going to talk about credit cards. Now, I know a lot of you every single day, maybe some of you don't get them yet, but once you're my age, there's always people who are wanting to give you credit. Lots of credit cards out there. A lot of people call it plastic as opposed to cash, which they call paper. Right? Not to be confused when you go to a grocery store and somebody asks you if you want paper or plastic in the bags. There's all sorts of types of different credit cards. You can go to Kohl's and get the Kohl's credit card. So when you shop there, they give you 20 or 30% off your purchase for the day. When you go in, you go to JCPenney or Sears. All these different places have their own credit cards. And that's essentially what a credit card is they're giving you a loan. Right? So instead of paying cash up front, they're saying you can get the item and then you pay us back over time with interest. Well, if you don't get a company card, right, say a Kohl's card, then you have the major ones. I'll just read them off to you here. You have Visa, MasterCard, American Express, and Discover. And what they do is they're in the business of lending. They don't want to sell stuff. They want to lend you the money and make the interest on it. And so what happens is you go to Walmart, and instead of paying the money up front, you are going to get the credit card out, and you're going to swipe it, right? And when you swipe it, what happens is Visa, we'll use them as an example, they're going to pay Walmart the money, okay? So I'm buying something worth $100. Visa pays Walmart directly, and then I have to pay Visa back. Well, Walmart doesn't exactly get the $100 because Walmart actually has to pay a credit card fee for all the credit cards they use. So let's say that's 3%. Off of $100, that means that they're really only getting $97. But because they have their markups, right? We've talked about how cost versus what they actually charge, there's always markup in there. That's how they make money. And so they feel that that 3% is perfectly fine because they've sold enough stuff to you that they've made up for it and made enough percent off of the sale of the item. So what then happens is Visa, right? So Walmart's in the business of what? Lending money? They're in the business of selling you stuff, right? A credit card company like Visa, MasterCard, American Express, and Discover, are they in the business of selling you stuff? They're in the business of lending you money. Their hope is that you won't pay it off in a month, although they'll always tell you that. Their hope is that you will extend it out and now you start paying interest. So with a credit card, first and foremost, once again, it's easy to use, too easy many times, right? And people get in huge financial debt because of it. And once you start building up a balance, all of a sudden you get more offers because people say, look, this person's racking up bills and paying interest. We want to make money off them too. And I'm sure that's exactly what they say. But what happens is they notice you're using credit. They notice that you're racking up interest. So they want to make sure that you have their card so they make money. Okay? One of the biggest things with credit, and we're going to go off a little side tangent here, is when you need credit is typically when you don't qualify for credit. So when you are financially sound and when you don't need a credit card, that's the best time to get one. Okay? Use it to pay gas, whatever you need to do, eat out once a month, and then pay it off. Because I hope it never happens to any of you, but there may come a time in your life where you need to use your credit card. And at that point in time, you may not qualify for one. So when times are good, get credit. That way when times are bad, you're able to make it through. A lot of my friends, when the recession hit in the mortgage industry and the banks were going out of business, a lot of them, the only way they were able to continue living was income and supplementing some of that income with credit cards. And once times got better, they paid their credit cards back down, and now the income is enough to pay all of their bills. And so you can see where credit can be used for good. But going out and just buying whatever you want, that's a dangerous, dangerous path to take. And as the saying goes, it's a very slippery slope. So you go through And let's say there's a really good example here in the book we're using that says you go out and you buy a new surround sound for your home. You've got the nice big TV, you got it for Christmas, right? You saved up your money, but you really want to watch that new awesome movie with all the superheroes and the sound and everything. Well, a TV's cool and all, but imagine if you get 7.1 surround with the center and the sides and behind you and the sub, right? And it's you can hear the cars crashing all around you, but you don't quite have the money to buy it right now, so you think, you know what? I'll get it on a credit card. And so you go and it's $500. Swipe. So let's assume, for this example, that your interest rate on that credit card is 18%. Okay? Now let's assume that's 1.5% a month. All right? Let's assume you pay that off in 12 months. Okay? So that means you're going to pay a payment of $45.84 a month. Your first month, that's $7.50 interest and $38.34 in principal. Now each month you pay, your interest payment goes down and your principal payment goes up. That's how it works. They always collect their interest up front, and as that goes down, then you start applying more towards principal. Same with your mortgage, same with any lending that you do along those basic principles. So you start off month 1, 2, 3, 4, 5. At month 12, you now owe 0 to the credit card. Took you 12 months to pay it off. All right! Well, how much did that $500 surround sound really cost you? If you did $45.84 and you did it for 12 months, you would have paid a total of $550.08. You say, that's not bad. That's okay. I'm fine with that. $50 to borrow somebody else's money. Okay. Well, what if you decide you're only going to pay $24.96 a month, so you pay it off in 2 years? The surround sound's probably getting outdated by then, and you'll have paid a total of $599.09. Well, you think, I don't have a lot of money, times are tough, I'm going to do $18.08. That'll take me 3 years to pay it off. Okay? You've now spent $650.74 by paying it off in 3 years. Say you make the minimum payment on that credit card, which would be $14.69, we're assuming, and that would take you 4 years to pay it off. That means for a $500 surround sound, 4 years later, you'll have paid $705. Now do you see why credit card companies want you to use credit? That credit card company, over the course of 4 years, made $205 off of you, just because they lent you $500. And they'll gladly do it every day, and there's nothing wrong with it. Okay? Credit cards are not bad if they're used correctly. Just like anything in this world, things are created for good, and evil will use them to hurt you and bind you, and that's that slippery slope we talked about. Bankruptcy is something that a lot of Americans, and worldwide we've seen and we've talked in previous classes, there are entire countries that went bankrupt because they became too far in debt and were unable to pay their creditors back. A credit card is issued to you by a creditor, someone who lends you the money. So it's very important to really look at what you're getting with a credit card. It's not free money. Nothing in life is free. Okay? Make sure when you're looking at credit cards, you look at everything, absolutely everything about them. So let's look right now. I pulled up on my other screen some offers. And these are as of today, okay, in this year. So here's one right now. It's a cash rewards credit card. You get a $100 bonus after you spend your first $500 in the first 3 months. Okay, that's kind of nice, right? You can get 1.5% cash back on every purchase every day. So whether it be gasoline or food, or you're paying tuition with a credit card, 1.5% back. Not too bad, right? Cashback doesn't expire. There's no limit how much you can earn. There's a 0% intro until September of this year. After that, the interest rate shoots up anywhere between 12.9% and 22.9%. If you transfer balances, there's a 0% fee or 0% intro, but they're going to charge you 3% for all the balances transferred. So if you transfer $500 over, they're going to charge you 15 bucks. But this is where you can be really smart. Say you have a credit card that was 20% interest, and you transfer it over there, and you get 0% interest for 12 months, 20, okay, 0. And they charge you 3%, 20, minus 3 is 17. You saved 17% that year on that credit card. Sometimes that's a very smart move as long as you continue to pay it down and you don't take that money and go spend it on something else, okay? That's crucial. So that's a pretty good one. To get that, you need excellent credit, it says. So I'm looking at a new one here. Let's look at from a different company. Going on down here. These are all the same company so far. Here's one from a bank. Earn 1.5 points for every dollar on every purchase. This one uses points, not percents. Okay, get 10,000 bonus points if you make at least 500 purchases in the first 90 days. And you can use that $100 towards travel purchases. Okay, book travel as you normally would and go online or call to redeem your points. You can redeem points to pay for flights, hotels, vacation packages, cruises, rental cars, or baggage fees. No limit to the amount of points you can receive, and points don't expire. So, once again, it's 0% interest, and this is actually for a full 12 months. The other one was only for a few months. Okay? There's no balance transfers because it won't let you. And then the APR will go up to 14.99% interest or 22.99% interest. This one has no annual fee. Once again, neither did the first one, but you need to be looking at that. Some cards charge you annual fees. Okay? Moving on down here, there's one that's 7%, or 7 months, 0% interest, 24% after, 22% after. Balance transfers, 12 months. So you can see when you're shopping for credit cards, you really need to look apples to apples, okay? You need to look what the APR is. APR stands for annual percentage rate, okay? Annual percentage rate. So when you're looking at that, annual percentage rate, if it's variable, that means it can go up and it can go down. It's all based on what the banks are borrowing at. So if the banks go up, your interest rate goes up, okay? So you need to be looking very closely at what that APR is. So when you go talk to the different banks, look at what the different credit cards, the APR is one of the first things, okay? Next thing, you're going to look at what are their late fees. What if you forget? What if it's the first of the month and you don't get paid till the 5th? Okay, you need to make sure when you set up your payments, you have that. What's your grace period? Meaning they don't charge you late fee if you pay within how many days? Is it 15 days, 20 days, 30 days? You need to be looking at that, okay? You also need to look at the cashback. So I always recommend people, if they can, they treat their credit card like cash. Meaning, if I have a credit card at $500 limit, but I only have $200 I can use to pay it off this month, then I'll only use $200 worth of my credit card because I'm going to pay it off every single month. And it's good for you that way because by using a credit card, it builds your credit score. Okay? That credit score enables you to get better interest rates and borrow cars, borrow a home, so on and so forth. So you want to use credit so you have a better credit score. All right? So use your credit card like cash and pay it off every month. You're going to get your bonus perks, right? The percent back. I always tell people, if you can do it that way, it's one of the best things you can possibly do for your credit. Next thing you need to look at is credit cards. You also have what's called a debit card. So a debit card is exactly what I just explained to you, except typically a debit card, or rather a debit card, you can only use the cash that you have on hand. Whereas a credit card, you can always go above and then you're in debt, right? But if you use your credit card like a debit card, meaning you can only spend what you have available to spend in cash, then you're better off. Debit cards typically, essentially it's just a check, to put it very bluntly for you. So you know how you can write a check and issue it that way? A debit card is like a check, just in plastic form. Remember we talked paper plastic. So make sure as you're looking at it, anytime you use a credit card, look at what perks you can get, what the APR is, and always make sure that you never, ever, ever spend more than you have available to pay off. Sometimes there are emergencies, and credit cards are an easy way to pay for those, but if you don't have the ability to pay it down, you need to be very, very careful when using those credit cards. Thank you.